Capital Markets Report, real estate trends and analysis for all property types. We're always looking forward to this report. Matt, what are some of the highlights?
Yeah, it was like you said, it's good to dive back into commercial real estate after we kind of covered a lot of the broader economy, which is important, but getting into how these different property types have performed and are performing is really nice. And Newmark does a really great job of giving us the fuller scope of the CRE markets in their 25-page report. NAR used to have a monthly report on the commercial markets, and they don't do that anymore.
Wonder why that is.
Maybe staffing. I don't know.
Staffing, yeah. We can reach.
But so Newmark is carrying carrying the burden now, and I very much appreciate the report that they released this month. Yes, you may not get the same level of detail as a multifamily focused report if you're looking for that kind of granular market information, but multifamily does not exist in a vacuum, and a lot of these real estate sectors have a lot of influence on each other, whether that's through directly attracting investors or through more indirect effects on a market or the economy. And it just says here in the headline is that the commercial real estate investment remains bifurcated, with multifamily and industrial taking the lion's share of investment and really the lion's share of returns. Multifamily has gotten more investor attention, but industrial has a lot more returns for at least 2021, and we'll kind of get into that in a second here.
Yeah. I mean, people are continuing to pile in. I mean, certainly not an exodus of capital. I mean, quarterly investment volume increased by 17.5% year over year to $190 billion in the second quarter of 22. Now that it wouldn't have been surprising, 2020 to 2021 because people were sitting on their hands in 2020, but 2021 there's a lot of investment activity, so that's just showing how it's picked up and hasn't dropped off even in the rising interest rate environment. So I think that's and again, to your point, Matt, multifamily remained the most sought after property type in commercial real estate in the pandemic era, with volume increasing by 42% year over year to $86.3 billion. So out of that 190, multifamily makes up 86. Again, I think these are good insights and something to think about because we're all thinking about them. So what does Newmark, what do they expect? The combination, or you want to take it?
No, you got it.
And I'm just reading here. The combination of persistent high inflation and slowing growth presents a nuanced challenge to property markets. Industrial and multifamily fundamentals are likely to prove resilient given record low vacancies and strong secular drivers. In this context, shorter lease terms are a boon. Office is more challenged as a weakening economy threatens to delay the office recovery. And retail, meanwhile, is perhaps the most surprisingly resilient owing to a shallow supply pipeline. Interesting.
Yeah.
To combat inflation, FOMC is expected to continue to raise rates throughout 2022, with a short-term rate peaking around 3.5% early in 2023. The market is currently pricing in a quick Fed pivot to cutting rates thereafter, with around 80 basis points in rate cuts priced in. Market expectations remain highly volatile, contributing to large swings in the 10-year Treasury bond as well as other financial benchmarks. Now, the next what to expect is rising rates have already forced an adjustment in the CRE debt cost, both floating and fixed rate. While the 10-year Treasury yield has fallen recently on rising recession expectations, CRE lending rates have been far less responsive to the same recession fears and lead lenders to determine more risk compensation. The end result is that debt costs over the next 12 to 24 months are likely to remain significantly higher than they were until recently. This, in turn, has already placed upward pressure on cap rates, particularly in negative leverage sectors like multifamily and industrial. And we've talked quite a bit about that, Matt.
Yeah.
Now, investors are using limited or no leverage are expected to have a considerable advantage bidding on and winning deals during the remainder of 2022, particularly in negative leverage situations and when interest rate volatility impacts financing. Similarly, properties with accretive, assumable debt will attract preferential valuations and liquidity. All true things that we're seeing today in the market. Now, while deal volumes have been extremely strong in the first half of the year, we expect activity to slow as a result of the change in the economic outlook and macro financial conditions. In past periods of financial pressure and recession, activity has dropped sharply. We expect the slowdown to be more measured as there have been a greater willingness on the part of sellers to adjust pricing expectations compared to past market inflections. Above average price appreciation over the last several years means that even with recent reductions in value, Investors, especially in multifamily industrial, have high levels of unrealized gains, thus facilitating dispositions even in the face of market uncertainty. So it's saying, hey, look, like, yeah, you may get a small price cut from like the top number that you were thinking right now today, but you're still like knocking out of the park in terms of returns.
Yeah, that cushions the blow a little bit.
It certainly does. So I think that they're right on track. I think that a lot of what we expect are kind of what we are seeing today. It's not necessarily too far in the future outside of some of those rate cuts.
Yeah.
What would you like to talk to? What would you like to feature on this report next, Matt?
The following page talks about CRE performance and inflation, and one of their lines, it says that only in 1991 and 2009 recessions did CRE fail to beat inflation. I think the only in that sentence is doing a lot of work. But to put it another way, since 1979, there have been 6 years when real estate returns did not beat inflation, according to this graph. Now, the graph here represents the average returns for all commercial real estate, but there's a 4-year period from 1990 through the end of 1993 where real estate returns did not outpace inflation. That's a pretty long stretch. It's not something that you can kind of get over. You can really find yourself in the wrong spot when that period is so extended like that. This did remind me, as a lot of things have, about Berkadia's work earlier this year. They covered similar territory in a report that we actually did mention last week, and the studies from Berkadia actually support Newmark's take, kind of minimizing the threat of a CRE not outpacing inflation. Basically, Berkadia said that CRE as a whole is an inflation-resistant asset class, with multifamily on the more inflation-resistant side. But for that 4-year period in 1991 is particularly
and it seems like they're related less to inflation, although they're certainly correlated, but more to recessions, and especially in 2009, in 2008, 2009, kind of a real estate crisis, and then the recession, which led to a drop in CRE prices in the early 90s. At the same time, we were seeing some moderate levels of inflation, and they were raising interest rates in that time.
Yeah, that period in the early 90s was particularly bad. It was kind of a stagflationary period as well. That kind of explains a little bit. And then I think that on the following page there is a look at, investor allocation over time. It's interesting to see how industrial investment has not continued to grow at the same rate as multifamily. Now, their returns, which we'll see in a second, the returns for industrial have been great, but it has not. It's kind of stagnated and gone down a little bit, the investment volume for industrial, whereas for multifamily just keeps going up and up and up. Now, when you look at the, I think it's on page. Page 9 or page 8 has the year-over-year difference in the addition to this total sales volume for the first half of 2022. What I'd love to see would be a list of top markets with the highest growth in investment sales, but this one does have it looks at the top markets for sales volume, which Dallas is the clear leader here, but it also has, you can see how much a given market has increased, the percentage of year-over-year increase in investment spending, and Manhattan has increased more than 150% in the past year. That's incredible.
It kind of makes sense just because like everyone was so bearish on New York City throughout the pandemic. And people were like, oh, New York's dead. And then I think people were like, maybe not. It's the financial capital of the world.
I mean, that's a real big big highlight to this kind of return to normal or whatever it is, but people are returning. Maybe that means that we're in the pandemic recovery. It's a pretty big increase.
It is a pretty big increase.
Now, the on page 14, we get back to this relationship between cap rates and interest rates. Essentially, their point is that the BAA corporate bond rate is a leading indicator for cap rates. And it has gone up recently, which suggests that we'll see upward cap rate pressure for CRE assets in the future. I'm not sure how or that this will play out in the same way for all asset types. I also don't know, I have a great big question mark on multifamily and industrial properties, that they see multifamily and industrial as the most amenable to cap rate expansion. But man, just looking at multifamily investment, the investor intention keeps going up and up and up for multifamily.
Yeah, and that's what's and the rents keep rising also. So the top line revenue increases, the demand for the demand for apartments from the user side, because single family homes are expensive, is going up, and then also trying to outpace inflation, solid asset class.
Yeah.
Yeah, no, multifamily is definitely a kind of favored spot to be. Now, I will note that in this chart here, Matt, it ends in March of 22.
Yeah.
And so that's like right when rates started moving and right when we started seeing some cap rate expansion. It hasn't like gone up, like it's not crazy cap rate expansion as we've we've learned just through price discovery and working on projects and just being in touch with brokers all across the country. Where we were in maybe the 3.5 to 4.5 range. Now we're maybe in the 4 to 5% range. So, maybe we've moved up, 25 to 50 basis points. But again, there's also all this top line NOI growth as well. But with this, triple B double A corporate bond yield, I mean, you'd have to at some point, again, like if you're looking at competition for yield, and at some point investors who are looking for income will move over to corporate bonds or municipal bonds if those rates are much more attractive, especially municipal bonds, because there's the tax savings, tax advantages for those as well.
Yeah, and another point that apart from the bonds is I think that industrial could be a lot more vulnerable than multifamily because of the way that their investment is a little bit stagnated, and multifamily
it was a much more more volatility in terms of like there's so much cap rate compression in a short period of time, whereas multifamily has been kind of on a steady decline. But you see, I mean, industrial took this just like large plunge. I mean, it's been steadily declining as well, but took a very large plunge kind of in right around the pandemic, where it dropped from kind of a 5 some cap rate to 4 sub 4. But multifamily just kind of steadily going down. But when they update this, there will be at least a little bit of a take up. That is for sure.
Yeah. On page 17, I've been referencing this excitedly. It shows the total returns by property type, which I think that pairs well a little bit with they had bar graphs for the investor, how much investment is in each property type. Now we're getting to see the total returns, and industrial, for as stagnant as it was, it is far and away the returns leader. Now multifamily is not doing too shabby. It's a solid second, and retail and office aren't doing too poorly. And I think what's interesting is that retail
office is kind of they're both.
Well, I was actually a little bit surprised that office didn't go into the negatives, whereas retail and hospitality in 2021, retail was down negative 7.5 and hospitality was down 25.6.
Yeah, that makes sense to me though, because I mean, for hospitality, I mean, people just don't show up. You can't book the room. Where office, like you still, those businesses are paying their rent for the most part. Most like businesses like still paid their rent. Some of the retail side, those are some of those users and tenants. They stopped paying rent or were asking for forgiveness. That was much more widespread. But now office just like is the whole, the future of office is still in question right now. I don't think that it's on life support and like offices are going to go away, but people are certainly just like rethinking how we're going to use the office, especially large firms.
The story and like it almost feels like a cliche to talk about remote work after 2 years of it, but like the story of remote work is not over.
I was into it. I went to an office this week, Matt, it was a hospital like administration office, but like their head office. And I was meeting with the CEO, and like there was nobody working in the office.
Man,
I mean, it was a hospital, I guess, so obviously the health concerns,
telehealth.
But like, but there was nobody there. I mean, it was like the CEO was there, who I was meeting, and that was it.
I have been curious about medical office and how telehealth might impact it, but man, it's not limited to a specific industry.
Yeah, that's a good question. Telehealth and medical office. I'm less concerned because I think that there's certain things, and my father-in-law is a dermatologist, and I was talking to him about this like a week or so ago, and like there's so many of the things that they do, like have to be done in person. Like, sure, there's some things that, we can do over a quick like call, but so he's a dermatologist, and so he's used to people being like, taking a picture of like, this rash or something, and he'll look at it and he'll be like, I think it's this, but a lot of, and this is like just family. Hey, can you, is this poison ivy? And a lot of times he's like, I think it's this. It's one of these things, you can try this, cream or whatever. But most of the time he's like, I need to take a look at it. Like I have to be there in person. And it's like, your dad's an anesthesiologist. Like you're not you're not telehealthing into that. So
those knobs and absentia.
And then I don't know, maybe, but then at the same time we have the demographic shifts of just the silver tsunami, baby boomers. Saw a graph of like the percentage of the U.S. population that's 65 and over, and just in the last couple of years that's just skyrocketed. So those folks there are just more overall users of healthcare in general, and so need to have the facilities to service them, and that's the demographic that's not necessarily going to be signed up for telehealth also. Maybe for a checkup, like, hey, I'm feeling sore throat, which I do. But good point. A little bit of divergence, but I think it's good. We don't talk a lot about medical office, and it's one asset class that I invest in that doesn't usually get featured because it's like a subcategory of office, but I'm glad we did talk about it. Because medical office has actually done quite well in the last year or so, quite a bit of cap rate compression as well. It can be a tough nut to crack to kind of get in. There's not a lot of operators. It's a little bit different risk profile, but pretty defensive in general.
Yeah, it seems like it would be pretty resistant to risk.
Yeah.
I think, telehealth is almost like wishful thinking for people that have waited in so many lobbies and waiting rooms. But,
exactly.
Yeah, you can't do everything.
If you just want a question, you can't get your doctor on the phone, and, that makes sense.
Yeah.
I want to take a look at this dry powder again real quick, Matt, before we move on. Again, the dry powder is, only moving up. It's been steadily moving up. This is for all CRE, but we're at $254 billion, right? $1 billion. Yeah. I had to make sure. Anytime I put the B in there, I have to confirm.
It says that it exceeds 2019 levels by 25.6%. It's 254 now. It used to be last year. It was at 242. And it's just steadily increasing. And if you look at the pre-pandemic, the steadiness of this increase in dry powder is unusual, and it is a divergence from the typical patterns. There's a little bit of ups, a little bit more ups and downs every year. But man, since 2017, things have gone up and up and up. Yeah.
And again, that's just, it's going to act as an anchor for cap rates.
Yeah,
for sure. So then let's look at kind of what people, what leverage people are using. Dry powder at 65% leverage, because you got that cap, you've got the equity, ready to go, the cash, but you're going to lever that up. So what does that actually, look like? I mean, that's just for multifamily. That's $194 billion ready to go, ready to deploy, into assets, and about $100 billion for industrial. One piece of this report, Matt, that I thought was really interesting, something that we have been tracking, so I was pleased to see this, is taking a look at all the debt that's going to be expiring in the next couple of years. Because again, there was so much bridge financing, and there was so much debt fund financing, and a lot of that's coming due in 23 and 24. And a lot of those were variable rates, and the rates that and if they were or weren't, if they had a cap, that cap was cheaper, and the cap's much more expensive now. And if they have to refinance, the rates are higher than they were a couple of years ago, without a doubt. And you've had a lot of revenue growth, but maybe you can't refinance because you need a higher DSCR. If you're going to go for a supplemental, you may not be able to, just because of the debt has changed. You're on pace off your income and net where your revenue and rents.
In my simple-minded explanation. Yeah. So these people have a good loan. They had a good loan, and now that loan is the term is finishing, and so they don't want to get a bad loan.
No, it's not necessarily bad loan. It's just that
there's a higher rate.
It's the business plan going forward with the higher rate may not make as much sense. Okay. And so they probably have seen asset appreciation, almost certainly. And so they are faced with two options. Typically, it's either sell or hold. And they're looking at holding and refinancing at a new rate. they may not get the loan proceeds in order to return any capital. And you don't necessarily have to return any capital. When we look at buying something and refinancing it, our goal is typically we want to see a nice return of capital to pay back down, our investors' equity to kind of de-risk the asset to some degree. Not always. Sometimes, we use, for example, if we're pursuing a HUD 223F loan, those take so long to put in place that you have to close on a bridge loan. But we close on a property we're using a short-term bridge loan, but we've already been working on the refinance paperwork before we typically even close on the property. Yeah. And so we close on the new loan within 6 to 12 months, depending on how quickly HUD wants to work.
Okay.
In that scenario, we're not looking at a cash out because the time period is so short. So if you're going to refinance in 2 or 3 years, you've seen the asset appreciate in value, but you're not going to be able to return cash to investors. You're just going to kind of roll the debt, but it's going to maybe be at a higher interest rate. So your cash flow is going down because you're bringing on more debt at a higher interest rate, and you're seeing the cash flow doesn't look that good. And, you could go for a floating rate and buying a cap, but the caps are incredibly expensive. The fixed rate will maybe give you more security and not having any rate volatility, but you're going to have a decent prepayment penalty. And so you're looking at, okay, we can't sell this thing and maybe refinance for another 5 to 10 years, or we could sell it now and book a profit for our investors.
Yeah.
And they're seeing that the idea of selling it and booking a profit is more accretive than rolling the debt and doing a longer term hold in some scenarios. Yeah. And so many people have been using bridge loans, especially again, the last couple of years, because they were more flexible. The agencies weren't as competitive, and you didn't always have to buy a cap, and you could finance some of your renovation costs. So there are all these great things about bridge loans until all of a sudden, the low rate you thought you were going to be paying is actually going to be twice because interest rates are being risen by, 50, 75 basis points.
Well, from the perspective of a buyer, you've mentioned, a lot of people skate and buy on low rates, and maybe they didn't, run as tight a ship as they even had to. Yeah. Because money was so plentiful and available. Yeah. So maybe we're gonna find some of those loans expiring.
Well, that's what they're showing here on this report, is that you see this big uptick of the kind of 0 to 3 year. Those would be the bridge loans that are going to be expiring. This big chunk in 2023. That's from bridge loans that were taken out in 2021 and 2022, or mostly 2021. And some that are going to be expiring in 2024. And you see how it just drops off because obviously you can't have there aren't any 2-year loans that are coming due in 4 years. But it makes up a big percentage. And I assume this is going to drop just because bridge financing all of a sudden, maybe not that it's not attractive, because it still is, but there's more risks associated with it than there were in previous kind of economic conditions.
That's interesting. I'm glad you noticed.
So this could be a buying. This is what we're looking out for a very strong buying opportunity, and just through our own independent research, through some of our own data sets, we've seen this ourselves. Is that 2023 and 2024, there's going to be quite a few loans expiring, and we think there might be some very good pickups at that point. So
that's really cool.